Welcome to our deep dive on tax-smart retirement planning for independent contractors and small business owners. Today, we'll expose the so-called 401k trap and show you how self-employed professionals can unlock far larger contribution limits and tax savings. We'll move step by step through the best plan types, how to layer them, and practical setup tips. Along the way, you'll see diagrams, comparisons, and quick quizzes to cement the ideas. Let's begin. First, we'll define why the traditional employee 401k mindset can limit business owners. Next, we'll explore solo 401k, SEP IRA, and the role of IRA and Roth IRA. Then, we'll connect these pieces into a layered strategy, review deadlines, and compare options. Finally, we'll share action steps, test your knowledge with a couple of quizzes, and wrap with key takeaways. Many business owners evaluate retirement savings as if they were regular employees, assuming that a standard 401k is the ceiling. However, self-employed status changes the game. You can access plans that combine employee-style deferrals with employer-style profit sharing, or you can choose ultra-simple options with high limits. In short, your business can be a powerful tax shield. With that framing in mind, let's examine each option. Now let's focus on the solo 401k. If you have no full-time W-2 employees other than a spouse, you're typically eligible. This plan is powerful because you can contribute in two ways. First, as the employee via salary deferrals. Second, as the employer via profit sharing. The combination can produce some of the highest annual tax deferrals available to an individual. If your spouse works in the business, they may also participate, effectively doubling the household potential. Many solo 401k also allow Roth employee deferrals, giving you the option to diversify between pre-tax and tax-free buckets. Additionally, the plan often offers more control, such as the ability to make in-plan Roth contributions or access plan loans, depending on the provider. Make sure to confirm your eligibility and design details with a qualified professional. Next, we'll look at an even simpler alternative that still packs a punch. Shifting gears. The SEP IRA is known for its simplicity. It's an employer-only contribution plan based on a percentage of eligible compensation, up to annual IRS limits. Many owners appreciate that they can dial contributions up or down each year, matching the business's profitability and cash flow. If you have employees, SEP IRAs require contributions for eligible staff according to plan rules, which can affect total cost. Accountants often favor SEPs for ease of administration and straightforward tax reporting. If you value simple setup with strong contribution capacity, a SEP IRA can be an excellent fit. Next, we'll layer in the foundational accounts that everyone should consider. Traditional IRAs and Roth IRAs are the bedrock. A traditional IRA may allow a current year tax deduction, depending on your income and coverage status. A Roth IRA, by contrast, offers tax-free growth and tax-free qualified withdrawals in retirement. Income limits can affect eligibility, so verify current thresholds annually. Even if you pursue a high-limit plan like a solo 401k or SEP IRA, IRAs remain essential. They provide additional flexibility and allow you to diversify your future tax exposure by building both pre-tax and tax-free buckets. Now that we've introduced each vehicle, let's compare solo 401k and SEP IRA head-to-head. Let's compare the two most common options for self-employed savers. The solo 401k stands out for combining employee deferrals with employer profit sharing, which can enable higher total contributions, especially at modest to mid-range incomes. Some providers offer Roth deferrals and even loan features. However, solo 401k generally requires that you have no full-time W-2 staff besides a spouse. In contrast, the SEP IRA is strictly employer-funded, but it is extremely simple to establish and operate. It can be a good fit for owners with volatile income who want to adjust contributions easily. If you have employees, SEP rules typically require proportional contributions for eligible staff, which you should factor into total cost. With the comparison in hand, let's visualize how to layer these accounts for maximum flexibility. This mind map places tax-smart retirement at the center and shows four main branches. First, the high-limit vehicle branch highlights either a solo 401k or a SEP IRA, with sub-branches for pre-tax deferrals, profit sharing, and a Roth option if using a solo 401k. Second, the foundational branch covers traditional and Roth IRAs, emphasizing deduction benefits versus tax-free growth and withdrawals. Third, The liquidity branch adds a taxable brokerage account to support pre-retirement goals and provide flexibility. Finally, the risk management branch reminds you that emergency funds and appropriate insurance underpin all investing. Together, these branches form a coherent, layered strategy. This timeline depicts typical sequence and deadlines. First is the business formation date. For a solo 401k, establishing the plan by year-end is usually required to make employees' salary deferrals, while employer profit-sharing contributions can generally be made up to your tax filing deadline, including extensions. A SEP IRA can typically be set up and funded by your tax filing deadline, including extensions. Traditional and Roth IRA contributions are usually due by the personal tax filing deadline, not including extensions. The timeline also includes quarterly estimated tax checkpoints to remind you to coordinate contributions with cash flow and tax planning. Always verify current year IRS rules and deadlines for your specific situation. Here is a quick comparison chart of features across solo 401k, SEP IRA, traditional IRA, and Roth IRA. We outline who contributes, whether Roth is available, administrative complexity, employee eligibility, and general deadlines. These highlights help you quickly narrow choices before you dive into specifics with a professional. To move from ideas to action, begin by confirming your business structure and compensation with your accountant. This informs contribution ceilings and plan eligibility. If you qualify, a solo 401k will often be the top choice. Otherwise, a SEP IRA can deliver strong simplicity. Next, add traditional or Roth IRAs as foundational pieces. Aim to diversify across pre-tax and Roth to manage future tax brackets. Open accounts early to meet plan establishment requirements and reduce stress. Automate contributions where possible and keep meticulous records. Finally, schedule an annual review to adjust for income changes, hiring, and updated IRS guidance. Now it's time to test your understanding. Question: which plan typically allows you to contribute as both the employee and the employer, enabling some of the highest total annual deferrals for a one-person business? Options: A. SEP IRA, B. Traditional IRA, C. Solo 401k, D. Roth IRA. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is Solo 401k. The reason is that Solo 401k combines both employee deferrals and employer profit sharing, producing a larger total potential contribution than a plan that only permits employer contributions. Question: which account type is best known for tax-free growth and tax-free qualified withdrawals in retirement? Options: A. Traditional IRA, B. Roth IRA, C. SEP IRA, D. Taxable brokerage. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is Roth IRA. Roth IRAs are funded with after-tax dollars, and if you follow the rules for qualified distributions, both contributions and growth can be withdrawn tax-free in retirement. Additionally, coordinate closely with your CPA to align contributions with quarterly estimates and cash flow so that tax planning and liquidity remain balanced. If a spouse legitimately works in the business, their participation can significantly increase household contributions. Be mindful that hiring full-time employees may change your plan eligibility, especially for solo 401k, so reassess if your staffing changes. Maintain a mix of pre-tax and Roth assets to hedge future tax brackets. Finally, choose a provider with features you value, such as Roth deferrals, in-plan conversions, or a broad, low-cost fund lineup. Next, let's reinforce the allocation concept with a simple visualization. Here are the key takeaways. First, Solo 401k is often the highest capacity plan for solopreneurs. Second, SEP IRA wins on simplicity while still enabling strong contributions. Third, traditional and Roth IRAs remain foundational and should be used strategically. Fourth, layering accounts helps diversify future tax exposure and maintain flexibility. Finally, set up early and verify deadlines and limits annually. To reinforce the structure, here is a concise Markdown-style recap. It lists your primary vehicle, foundational accounts, liquidity through a taxable brokerage, a risk base including emergency funds and insurance, and the next step of coordinating with a professional and opening accounts early. Now, before we close, let's add an important disclaimer to keep expectations aligned. This content is for educational purposes only and does not constitute tax, legal, or investment advice. Retirement plan rules, eligibility, and contribution limits change frequently. Your optimal strategy depends on your business structure, income, and personal goals. Consult a qualified tax professional or financial advisor before implementing any strategy discussed here. To summarize, think beyond the employee 401k framework. If you qualify, a solo 401k is often the strongest option. Otherwise, consider a SEP IRA for simplicity. Add traditional or Roth IRAs to balance pre-tax and tax-free savings, and use a taxable brokerage account to fund goals before retirement age. Set up accounts early, automate contributions, and review annually with a professional to stay aligned with changing rules and your evolving business. Thanks for watching. If this video helped you rethink your retirement options, please like the video, share it with another business owner, and subscribe for more practical strategies. Tell us in the comments which plan you're considering and what questions you want answered next.